You know, some people say that the only two certainties of life are death and taxes. Well, I really can't do anything about death. Look, it's part of the circle of life and we have to accept it. But taxes? Well, that's something we might be able to give you some advice about. So if you want to know more, stay tuned. Hey, good morning, everyone, and welcome to Scan FYI. So we took a little hiatus for a couple of weeks. It was summer. We all needed a little vacation, but now we're back. And my guest today is Adam Rubin from the law firm of Levine, Furman, and Rubin. Oh, I said it right. Okay, and you know, this is part 2 of a series that we're doing on why is estate planning important. And I will put the link to part 1 in the description, because if you missed it, you're definitely going to want to go back and check it out. So good morning, Adam.
Good morning, Andrea. Great to see you again. And thank you for the intro and having me.
So is there anything else that you want to share with the folks about yourself or your area of expertise before we get started?
Well, I just say this, you said Adam Rubin from Levine, Furman, and Rubin. Perhaps I'm more proud to be Adam Rubin from the board of SCAN. So that's
yes.
really what
Oh
I
my
tell
God.
people.
You know, I forgot.
The firm starts after, but that's really what counts.
Yes, that's right. That's right. Yeah. So it's never too late to welcome Adam to the board of SCAN. We're lucky to have you with us. But let's get right down to it. Taxes. Not a happy subject for anybody under any circumstance, unless you're getting money back. then I think we're always happy. But what do we want to say about taxes? And we're kind of talking about for seniors, and you know, this is relevant to some tax planning that older folks we need to do.
So I want to talk about, and this is really related specifically to death taxes more than income taxes.
Death tax.
Okay. And when you pass away, there's a couple of death taxes that we need to worry about. And some of them we might not. Now, I always say death taxes is a little bit like musical chairs because it's always changing. The exemption amounts and whether it's eliminated or states have it. So a lot of what I want everyone can write down what I'm going to say. That's good always, but maybe use a pencil because it changes. In fact, most of the time, the tax law changes every 10 years from a federal perspective. Okay. Now, in New Jersey, we have 2 kinds of taxes. Okay. We have the inheritance tax, which applies to people getting an inheritance. Okay. And I always make the joke with clients and call it, it's almost like the best way to describe it is the flight attendant tax. Because if you're leaving assets to a parent or a grandparent, a spouse or children or grandchildren, and if I stand up, you could really see children or grandchildren, then it doesn't apply. But if you're leaving assets to a niece or a nephew or brother or sister, some of the far-reaching relatives or friends or cousins or acquaintances, the inheritance tax applies in New Jersey.
Okay, so can we just also clarify, Adam, that what you're talking about, we're talking specifically about New Jersey, and so it might be different for people who are listening from a different state. Is that accurate?
Yes. Every state, we're going to talk about federal, which of course applies to all the states, but every state has their own tax law.
Because that way we can make it the most confusing possible.
Of course. And
yes.
New Jersey's, of course, yes. New Jersey, our great state, is certainly doing their part.
Number 1. Okay.
Yeah. So this is New Jersey specific. If there are questions about New York, I can answer those. I do know the rules for some of the other states, but I'm only admitted in New York and New Jersey. Okay. So New Jersey, we have, as I mentioned, the inheritance tax. And that doesn't matter how much you have. It looks at who's receiving the assets. So if it's passing to a child, just to recap, a child, a grandchild, a spouse, parents, or grandparents, you don't need to worry about the inheritance tax. Anyone else besides a professional organization, so a charity, the inheritance tax applies. Now, the rates for the inheritance tax, they go at a broad picture, they go from 11% to 16%. Okay. And again, it really depends on the relationship you have to the person. So I always say it's quirky because if a New Jersey resident passes away with $11 million, then there's no and they leave everything to children, there's no inheritance tax due.
But if you leave that to your best friend, that's another story.
If you leave $50,000 to your best friend, there's a tax due. It's crazy. A client once told me, she said, it's unfair. It seems New Jersey picks on single people who don't have children. And I mean, you can make that argument, I'm not I'm not a lobbyist, so I don't know the reasoning, but yeah, you can make that argument. And of course, New Jersey, we have to throw our own quirky twist on it, right? If someone leaves assets to stepchildren, it's free of inheritance tax.
Oh,
But
okay.
get this,
Oh,
ready for Andrea, are you sitting down? It's going to get really crazy.
yeah, I'm strapping myself in too. Yeah.
If you leave assets to a step grandchild, New Jersey's going to get you. Want me to explain why?
Yeah,
Oh,
yeah.
I have no idea. No one does.
Oh, okay.
It's the quirkiest rule. It's so funny, but it's so funny, but I don't know why they have that rule. But it's just for step grandchildren. It's for step grandchildren, they tax it and they can tax up to 16%. I don't know why.
Well, I don't know why covers a lot of territory, I suppose, when you're talking about taxes.
Yeah. Now for New Jersey estate tax, in 2018, New Jersey eliminated their estate tax officially. So the estate tax doesn't look at who owns assets. I'm sorry, it doesn't look at who's getting the assets, it looks at who owns them. So if someone's getting assets in New Jersey, and it's, it used to be for a long time, New Jersey, there was always to talk that New Jersey was the worst place to die. Because it used to be that if you had over $675,000, which in New Jersey, it's a lot of money, don't get me wrong, but New Jersey, a lot of the houses alone are that amount.
That's true. Yep.
And it used to be for the longest time, it was if you go over that amount, there's an estate tax. Okay. So but they eliminated that. This was the year they eliminated. This was the year. Remember, they brought in that tax on gasoline. I think I believe it was 13.5 cents a gallon.
Okay.
That was the trade-off they made.
Okay, to eliminate the estate tax.
Right.
Okay.
So what they did is they said, they realized that a lot of wealthy people were leaving the state and going to Florida, which doesn't have an estate tax, So what they did is they said, we need to we're going to increase the gas tax and eliminate New Jersey's estate tax. Now, everyone always assumes that they're going to bring it back, There's no talk about it right now. Believe it or not, New Jersey last year in 2021 actually had a surplus between the money, the bonds from COVID, and also the state sold bonds. So it's not on the radar. Do I think in my gut at some point during my lifetime the estate tax will come back? Yeah. But it's not, it's not on the radar right now.
Okay. And Adam, it's not in place anymore, but when it was that money that just came right off the top?
Yes.
Okay.
So the estate tax came off the top. So if you had, and it was the rate we use, the New Jersey estate tax, the rates are crazy. They jumped from, in the beginning, I think it was 33%, then it dropped down to 7%. I always just on an average use 10% as the number to think about with it. But I don't even know if it was ever 10% because it was always like this. It was a roller coaster. Okay.
Strange. Okay.
Yeah.
Not much you can do about it.
Okay, right. But again, there's a lot they did about it. They got rid of it.
Well, but it's gone. Okay,
Yeah.
So I'm crossing it off, but I'm still using pencil.
Thank you. Thank
Because
you.
it, might come back. Okay.
Now the federal exemption amount. So right now, I don't want our listeners to be depressed by the next sentence, but right now is a terrific time to die from a tax perspective.
I'm not even going to address that statement.
Sorry, but you're talking to a tax attorney. So, because the federal exemption amount, you sitting down, Andrea?
Yeah, yeah.
It's 12 million per person right now. So married
I'm
couples get
good. I'm good, everybody. Yeah.
okay, but I know probably very close, so just be careful with some of the, be careful.
In case I get a raise. Yeah.
Yeah, I would talk to Michael.
So that's a big number. A
Yeah,
big number. Yeah.
I don't think it's in my recollection, it's never been this high. There was one year it was eliminated, but it's never been 12 million per person. Okay. And again, if you're married, you get two exemption amounts. So you could have 24 million.
24 million.
Yeah.
Big numbers.
Now, here's the thing. If the rate ever does apply, then the rate is 40%. So,
Okay, so you have, let's say, 15 million
right. And you're single.
and you're single,
Right.
then your estate tax is going to be 40% of that. And that just like that's a done deal.
It's always been that way. It's between 40 to 45% historically. So, right. So it gets high very quickly for some of those wealthy folks,
Yeah.
Like, I don't know, are you a sports fan, Andrea?
I'm a baseball fan.
Okay, but you've heard of the Miami Dolphins?
I have certainly heard of them.
Okay, Dan Marino. The Miami Dolphins used to be owned by a gentleman named Joe Robbie. And when he passed away, back nowadays, every team is owned by the billionaires. They're so wealthy. Back in the day, it wasn't like that. A lot of these teams were family owned. So Joe Robbie owned the Dolphins, which was obviously a nice thing to have in your wallet. But when he passed away, with that estate tax rate of 40%, the government sent the family a really large bill. And that was the only money the family had. So that meant that was the only asset the family had. So that meant they had to sell the team to be able to pay the tax. So it shows you how that 40% can get high quickly.
Absolutely. Yeah. I mean, I feel like most people listening are probably not in that category.
I agree.
But nevertheless, I still think it's really important to know that, I mean, sometimes this is a lucky break because then there's no federal estate tax. So
right. In 2010, I know you're a Yankees fan, right? And we always tease Michael about being a Mets fan, but 2010 was the year, as you know, the boss passed, George. And there wasn't an estate tax the year Mr. Steinbrenner passed. So his family was able to pass the Yankees on free of any tax. So this,
it is kind of amazing when you talk about how it relates to a sports team or something like that.
yeah.
But yet it still feels like some people just feel like they really take a beating on, maybe it's just the inheritance tax, and maybe it's because people don't even realize, if a parent, a grandparent, but if I want to give my friend money, my nephew, that sort of thing, I'm guessing a lot of people don't even realize that person who's getting the money is going to get hit with this.
Right. No, people don't realize it. And it's a big thing with that inheritance tax back to New Jersey.
Yeah.
Because remember, that's not based on what you own. That looks at who's getting it.
Who's getting it.
So you have to be a little careful because, you have to decide if you want it to come out of people's shares or if you want it to come out of the pot. Like, let's say I'm leaving you, Andrea, you know how much I like you. I'm leaving you $100,000, right? And I'm leaving my wife everything else. All right.
That seems reasonable.
She listens to these, by the way, so boy. But so I leave her 100,000. The question is that going to should the tax come out of your share or should it come out of my wife's share for the pot? Right?
Oh, that's interesting.
Yeah. And it's so important to outline this because that's how we avoid court when people pass away and fighting and bad feelings.
So if the money, and again, I think everyone who's listening can really now clearly understand, if you didn't see the importance of estate planning before, wow, if this doesn't make you figure it out, you need to talk to somebody who's in the know, not just Google it. But if you're wanting the money in the pot to cover somebody's inheritance tax, and you're leaving, let's say, multiple people $100,000 or whatever it is, does that mean that the money is skimmed off the top for the taxes? And then what if there's not enough left to cover how much you said you were going to leave people?
Right. Well, that's certainly a problem. If it's you pick if it's attributable to certain people or if it should come off the top. You pick how to do it. But there are scenarios where there's bad feelings. I have someone
Of course.
we have a client who left her, and I'm sorry, I know we're getting very taxi, but this is fun. A client who left an IRA to her caregiver, believe it or not. We didn't prepare a plan and left everything else to a friend. But by the time they were done paying the tax out of the estate, the friend didn't get anything. But yet the friend is holding a piece of paper, a will that says her name in it.
Right.
So that creates those bad feelings, So it's very important to make sure, that your wishes are understood. And if that's what that person wanted, that's okay. But it's just you don't want to be careless and have slippy tax consequences.
So naturally, if you're doing your own will or you're just writing notes about this, you may not realize anything that Adam is talking about. You might not be aware of it, and I'm guessing a lot of people aren't aware of all this. So, Adam, how are people going to protect themselves? What do we need to do?
So I'm a big fan, and we always talk about this. I think it's why I agree so much with everything Scan does. Education is king. Education is powerful. And I caution people, I don't want Scan or Adam Rubin to be sued by Google, but I caution people about relying too much on the internet. I really think you need to talk to a professional. It can be me, but there's so many great lawyers out there. If it's not me, that's okay, but you need to talk to professionals who do this and practice in this area, and just so you understand, that doesn't mean you should call Adam or call some of my colleagues and necessarily sign up right away, but just use the education,
Right.
understand it, so you can make a smart, educated decision.
Well, this underscores the importance of speaking to someone who's in the know, like Adam, or, as you said, Adam, there's many qualified people out there, and we will put Adam's contact information in the comments. But I can certainly see where if you do this incorrectly, you're going to have a lot of unhappy people. You'll be gone, but those unhappy people, and it could be your children, it could be your relatives, just because you just didn't know. You didn't know the right thing to do. So obviously, if a client comes to you, you're going to get the whole story and advise them on the best way so that everyone gets the maximum that they would be entitled to.
Absolutely. That's the big thing. We want everyone to, I just want people to understand it. A lot of people, our firm was built, I'm very lucky. Roger Levine, Lenny Furman, the founders of the firm, they had tremendous tax background, CPAs, all these degrees. I have a lot of tax background, but it was always taught to me, you don't want the tax tail to wag the dog. We're not always going to have, but we have to still understand it just so we can make educated decisions. If I want to leave $100,000 to Andrea and it's going to be taxable, I think I should still do it, but I should understand it, understand the consequences, understand where it comes from. That's my big thing.
And, what would you advise if you're leaving 100,000 to me? Should only be the case, right? But wouldn't it be the right thing to do would be to share that with me and then make it known so that I understand that I'm not really getting $100,000. There is a tax consequence. I think that's an important little detail that you would need to share.
that's a personal choice. I think you just
I
have to
guess
be,
so. I
because
guess it
my
is.
one concern, if I share it with you, and then frankly, next week you upset me, and I update my documents and only give you 50, that only, I
Okay,
give
I
you
see.
50,000, then all of a sudden Adam passes away. Andrew's walking around and saying, do you believe that guy? He only gave me 50,000. He promised me 100, as opposed to saying,
Oh,
wow, he
what a
promised me
guy.
100.
What a guy. Yeah, all right. Well, I mean, I guess that's a fair thing to say, but if you're listening, you have to realize that if some just because someone leaves you money doesn't mean there won't be an inheritance tax that you will be liable for. So it's totally dependent on who is getting the money.
As of now, because New Jersey eliminated the other tax. And
All
the
right.
federal, I'm just going to say, I want to say one more thing about the federal, Andrea, if that's okay. The federal amount, we said it's a crazy high amount now. It's 12 million per person.
12 million.
It's going down to 6 million at the end of 2025.
Huh.
And depending on who's elected and various things, it could go lower. They say, I mean, it could go, some people say 3.5 million, some people say 1 million, You don't hear a lot about it right now, frankly, but it's always subject to change, the tax law.
Well, I guess that I would say that all of these rules change almost every year. So if you've made your will, if you've done all of this, and if the laws change, is that an opportunity that you might want to re-examine your choices of the money that you've left to people?
Oh, absolutely. And that's why our firm, we always say, the moment a law changes, you're getting a letter from us. And I think, just because it's always time to review it, just understand the consequences. Because I can tell you in 2018, when that law changed, we were incredibly busy because everything was designed with the New Jersey low estate tax. And when they eliminated it, everyone wanted to come in and say, do I need to make changes? Can I make it more restrictive, more flexible? It was a lot of different planning.
So here again, if it's just me doing my will, and I'm not necessarily in the know about laws that are changing, so you may only know this if you've worked with a professional a tax
Right.
person. They're going to
And
notify you. So again, another reason to have your estate planning done with a professional.
yeah.
It just makes sense.
Yeah, and I always say, Andrew, my biggest competitor, there's no one in town who's a competitor. They're colleagues. My biggest competitor is the Google machine and the next door neighbor.
I can totally see that. Yeah. Because everybody know that's the thing nowadays. Everybody knows best.
Right.
But you know what, guys? You don't. You don't. You don't. That it's true. If everybody knew best, there'd be no need for to have your taxes done professionally. There'd be there'd be no need for anything. We could manage our lives perfectly, but Dr.
Drink to
Google,
that.
Mr. Google, yeah, it's just so I hope everyone has found this really very helpful. I feel like I've learned a lot myself. And remember, this is part 2. I'll put the link to part 1 in the description. Definitely worth going back and watching part 1. And we are going to have a part 3 coming down the pike as well. So stay tuned for that. But Adam, thank you very much for making us aware of a very important topic.
Yeah, listen, again, I really, like I said, we're an education-based law firm. It's an education-based field. That's why I love working with Scan. It does such great things. And I'm very, very thankful and grateful for this opportunity. It really means a lot to me, Andrea.
Well, we feel that education, knowledge is power. And part of our mission here on FYI is really just to educate everyone about resources that are available and just, again, general knowledge. And something like estate planning, I do feel a lot of people just say, it doesn't really affect me at all. But it does. And especially if you're a senior and you're single, it may affect you a lot more than you realize.
Absolutely.
Yeah. All right, everyone. Thank you for listening today. And remember, if it's important to you, it's important to us. I'm Andrea Tarr, and we'll see you next time on Scan FYI. Bye, everyone. Bye, Adam.
Bye, Andrea. Thanks for being great.